Number one is, appropriately enough, the single worst stock pick that I have made personally in the last 3 years. It was on June 28th of 2017. It was in the Motley Fool Rule Breakers service, and the company is Trivago. That's right, that meta search engine for travel, bookings, finding the best hotel. It's a global company. And Trivago, I picked at $20.95 on that fateful day in June. And I'm sorry to say that these days, as I tape this podcast on the afternoon of Tuesday, January 15th, Trivago has gone from $20.95 down to $6.22. Yep, that's down 70%. So what is a reflection or thought that I have about Trivago, other than I should mention that a year ago, this one was also on the list. In fact, a year ago, Trivago was my fourth biggest loser of the previous 3 years. So yes, these recur sometimes from one year to the next when they do very poorly and then don't bounce back, which has been the case for Trivago. So what is one lesson we can take away? Well, Trivago is, these days, the market cap is about $2 billion, so it remains a fairly substantial company. This is not one of those companies that has been so crushed that it's like a little tin can that's been flattened into a micro cap of a stock. We'll be having one of those coming up shortly. Now, this is still a fairly well-known, fairly substantial company. But the problem that Trivago has faced is that a lot of its business was coming from two primary sources. Paid kind of search listings and making money from the big players. The two largest travel portals were more than half of Trivago's business when we picked the stock, when I picked the stock a couple of years ago. Expedia, which is a part owner of Trivago, and Priceline. And a natural vulnerability for a business like this, again, since it's down 70%, you can imagine that this was over $5 billion as a company when I first picked the stock. Now it's down to just $2.2 billion. But the company began to suffer from these two big dogs starting to say, you know, we're not actually going to pay you at the same rate because we're such a substantial volume player for you. Both Expedia and Priceline started to undercut themselves and pay lower and lower rates for search successes on Trivago. And that really hurt the company and continues to have hurt the company. So I think a lesson here, some of my lessons are about the stocks themselves and about how we invest in those stocks, but this is actually about the business and the business consideration. So lesson number one, recognize the vulnerabilities of your companies. Now, it is something that we recognize. This wasn't a surprise to us that Trivago was very dependent on these two players. And at one earlier stage of our corporate history at the Motley Fool, we were very dependent on just a few big discount brokers. That back when the Motley Fool was free and Fool.com was a free site, ad-supported, it really, really hurt. I remember back in the day when a few of those discount brokers that we were sending lots of customers to said in the horrible year of 2001, as the NASDAQ lost over 60% of its value, they said, we're not actually going to advertise on your site because nobody's clicking any ads and we don't have money to advertise on your site. That hurt us a lot. We were a company that was highly dependent on a few sources of revenue. And that's kind of Trivago, even though it's a much bigger company than the Motley Fool. So it's just something to be thinking about and conscious of when you're investing in stocks. And it isn't to say it never works, because we picked Trivago knowing that, and yet in this case those companies began to lower their rates and really hurt this company. So that's a lesson to learn from this $2.2 billion company today. By the way, I should mention, a year ago it had dropped from $20.95, as I mentioned, in June of 2017. It had dropped to $7.31, and 1 year later it's now down to $6.22. So the stock has actually sold off, not dramatically, but another 15% over the last year. And it's a reminder that we don't bottom fish much at all at the Motley Fool. If you want to take a second lesson away from this one, you won't see me re-recommending Trivago anytime soon to Motley Fool Rule Breakers members, because when a company is down and out like this, I need them to prove their way back into my confidence in them. And so that's kind of how I handle companies like Trivago. And yes, often they do kind of just keep sputtering along, and this stock is actually down from where it was a year ago.